All right, futures back down this morning. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, U.S. equity futures reversed earlier gains on doubts the Federal Reserve can significantly cut rates this year after Jay Powell said inflationary effects of tariffs should be transitory. Nvidia will spend several $100 billion to buy U.S.-made chips and electronics over the next 4 years. CEO Jensen Huang told the FT, "We go live to the GPU tech conference in the next hour," and the U.S. consumer is in focus after Darden missed profit and revenue estimates with fiscal third quarter earnings. The owner of the Olive Garden says the environment is challenging. Let's take a look at where markets are trading. Equity index futures are down on the S&P right now, more than 0.5%. NASDAQ 100 futures down 0.2%. This after a rally into the close yesterday on what was seen as a dovish Fed. Of course, the Fed did exactly what we thought they would in terms of rates, but they raised their estimates on inflation, lowered their estimates on growth, and you can see as a result the 10-year yield is moving down below 420 now. We've been watching this 430 level, and we have breached that and then some off 12 basis points. Some of the stocks that we're watching today, I mentioned Nvidia. Its CEO told the FT it would spend hundreds of billions of dollars right here in the USA over the next 4 years, $500 billion globally through 2028. You can see the shares right now down 0.6%, but they could move as the GPU tech conference continues. We're going to go live to that conference later in the program.
Maybe good for the United States, but more money, really, for Nvidia at the end of the day. We'll keep an eye on all of that. We're also keeping an eye here on Darden Restaurants, up 1.5%. They had reported mixed third quarter results, but reaffirmed its comparable sales forecast for the full year. We'll be keeping an eye on more consumer stocks as well this morning, but really we are talking about the Fed because it is getting a mixed reaction from investors, from economists. Take a listen.
When growth slows down, which is the stack part of stagflation, then the Fed should be cutting. The inflation side of the problem is that if inflation goes up, which was their forecast, then the Fed should be hiking.
If you're in corporate America and you hear that, what do? You stop spending and you hold all the capital you can. This is a very dovish Fed.
I think this was much more hawkish, and the Fed not quite going to one rate cut, but the number of people who are expecting one rate or less cut this year going up.
There's kind of clear elements of both of these here. I think the market's view is it's not as hawkish as was anticipated.
I think the risk coming into this was maybe we just saw one cut in 2025. We kept the two. But going forward, I think we should be baking in some widening credit spreads, and we would view that as an opportunity.
The top headline for me is, I can't believe Jerome Powell said transitory again. But this is really something that Scott Bessent has been calling for earlier this month. He said, look, if anything's going to be transitory, it's tariff-caused inflation because it's a one-time reset of prices. At least that's their theory. Still, I didn't expect the T word to be used in the press conference.
It is a little bit scary. I mean, this was a word that investors have hated. They were so frustrated with the Federal Reserve to be using this in the first place. Now it's back, to your point. But, you know, there is a silver lining. Even though they're seeing growth slowing and inflation rising, another scary scenario.
Stagflationary scenario.
Exactly, which is really a double-edged sword in a lot of ways. There are some notes of calm in this market. The VIX is still well below where it was last week. It was at 28 at its highest last week. It is now back to 20. And what you're seeing because of that is investors have been willing to buy the dip in some instances, maybe not so much this morning, but also you're seeing deals come back. You're seeing an IPO roadshow starting in this market. With all the pains we've been seeing, it is actually kind of alarming to see that kind of confidence to go public in this market still. So you are seeing signs that investors are ready to start moving again.
Right. And the bottom line is the dots are still showing 2 cuts this year. So I think the market saw that yesterday as dovish, even if Farrow thought it was hawkish. Let's discuss market sentiment with Conference Board senior U.S. economist Yelena Shulyatyeva. She joins us via Zoom. And Yelena, I think it's very interesting that they didn't change, that the dot plot didn't change, at least at the median, 2 rate cuts this year, while they expect inflation to be higher than they previously forecast. Wouldn't they want to at least hold rates steady if inflation is still 80 points above their target 3 years out?
Well, they want to hold the rate steady for the time being. I think that's what we are going to see. The question is which way it gets resolved. Is it going to be weaker growth and hurting the labor market in the end, or is it going to be inflation? And the Fed seems to be telling us that they think that they're more concerned about growth. Look at the summary economic projections. They revised down GDP growth much more than they revised up inflationary projections. And you know what, Matt? I almost jumped out of my chair when I heard Chair Powell saying transitory again. I totally agree with you. This was a very dovish signal for me, actually. And again, if you look at the summary of economic projections, you see that they revised up inflation much higher in 2025, but going further, they didn't really touch the inflation projections. I think that is also telling you that they think that tariffs may be somewhat transitory in nature.
How big of a problem does this create? Because if you're revising growth lower and inflation might be sticky, if not higher, stagflation becomes a significant fear. But what would it take to get into that scenario? Is it still very far away?
I think it's, the fears of stagflation are exaggerated. You have to have inflation expectations de-anchoring for that scenario to really take a hold. Yes, the developments, weaker growth and high inflation are stagflationary, but unless you really lose, confidence in the Fed and what they can achieve with the monetary policy, stagflation is not going to be such a big thing. I don't think that's in the cards just yet.
Yelena, President Trump weighed in as he has said he believes he has the right to do. I mean, frankly, most presidents at least say this privately, what they think the Fed should do. But he posted the Fed would be much better off cutting rates as U.S. tariffs start to transition, ease their way into the economy. Do the right thing. April 2nd is Liberation Day in America. Taking aside all of the extra drama that he added in there, what do you think would happen to the U.S. economy if the Fed were cutting rates right now?
Well, we really have to wait and see what happens on April 2nd and going forward. For now, and this is another word the Fed used, uncertainty. They used it in the statement, and Chair Powell reiterated it during the press conference. Uncertainty is weighing on growth, and we don't have to wait for the impact to transpire. It's already happening. So I think that, uncertainty will shave off some basis points from growth this year already, and that is already taking place. Going forward, we will see what kind of tariffs they imposed, what the rate will be, and all the other details. But, our estimates show that if you combine China, Canada, and Mexico tariffs the way they were advertised, that could shave off 1 percentage point from growth this year. But that will raise inflation as well. The bottom line here is that, yes, tariffs are inflationary, but at the end of the day, we think that slowing of growth and a lot of uncertainty in the economy will weigh on inflation down the road, and eventually the Fed will have to lower rates.
All right, Yelena, great to talk to you today. Thanks so much for joining us on Bloomberg Television and Radio. I listened to you this morning with Nathan Hager. Conference Board Senior U.S. Economist Yelena Shulyatyeva on the Fed. Let's take a look at what's going on with futures right now. Keep in mind, we had a rally after this, and really markets shot up after the press conference, during and after the press conference. The gain was far over 1%. We were through 57.10 on our way to 57.20 on the S&P. But now it looks like that relief, I guess, to the Fed's dovishness has worn off, and S&P futures are down 0.6%, NASDAQ futures down 0.75. Russell futures even worse. Obviously, the small caps need rate cuts more than anyone else.
Yeah. Speaking of love needed, I want to look at some of the movers under the surface this morning. Tesla lower by about 1.5%, 1.6% pre-market because, of course, a recall of Cybertrucks in the United States. Tesla estimates that 1% of the trucks sold are at risk of losing pieces of steel trim along the exterior, which are joined by an adhesive. Tesla has recalled the Cybertruck 6 times since launching the pickup in November of 2023. And I might remind you, the stock now at $232. This was the stock in December at $480 nearly. And you actually have Dan Ives, known for being very glowing about the stocks that he covers, out with a note, Matt, that says that he should call it like it is, that Tesla is going through a crisis and that there's one person who can fix it, and that's Elon Musk. And the problem here is that, of course, that it has become so politicized as a company, and that has created some issues for its brand.
And it's interesting, right, because Dan Ives is typically fairly bullish. Fairly bullish.
Just a little bit.
He has an outperform on Tesla, a $550 price target on the stock. So for him to come out and criticize the company and point out that, you know, Musk is Tesla, Tesla is Musk. These things cannot be separated. And that provides a real problem for investors is interesting to say the least. I want to also point out, while we're on the subject of cars and tickers with T, S, L, and A in them, Stellantis is moving down more than 4% now in the pre-market. The chairman of Stellantis, Johnny Alcon, was talking yesterday and drew a lot of attention for some comments he made about Italy, saying that tariffs will affect Italian production. However, Stellantis still is going to follow through with a commitment to invest 2 billion euros in Italy, 6 billion euros in orders from that country. So he says, you know, they're going to continue to see car production levels higher through 2026, even though tariffs impact the vehicles. I have a Stellantis.
You do?
Car in my garage. Yeah,
I had
Dodge
no idea.
Challenger Scat Pack wide body with a 6.4-liter naturally aspirated V8.
Wow. I don't know that much about my car, but I do have a Beamer, so I am now interested in cars. Anyways, we're going to switch from cars next. We're going to talk about Nvidia, because Nvidia CEO Jensen Huang has laid out a plan to spend hundreds of billions of dollars on American-made chips. I wish it was that easy for the car industry, but it looks like it's not going to be that easy for Nvidia either. We're going to bring you more on that report next. This is Open Interest.
Let's get to high interest now. A look at what's making headlines around the world. Nike has lost 44% of its value over the past 3 years, and we may get another reminder why this afternoon. The Beaverton, Oregon-based shoemaker will post fiscal third earnings after the bell. Analysts project quarterly sales shrank 11%, which would be the biggest drop since the depths of COVID. The CEO, Elliott Hill, who took over in October, has been clearing out the ranks. The departures of the chief strategy and transformation officer, as well as the chief communications officer, were announced just yesterday in an internal memo. FedEx, Micron, and Lennar will also announce earnings after the bell. QXO has agreed to acquire Beacon Roofing Supply in a deal that values the distributor of roofing, waterproofing, and exterior products at $11 billion, including debt. The agreement ends months of back and forth between the two companies. It avoids a full-blown hostile takeover battle. QXO will pay $124.35 a share for Herndon, Virginia-based Beacon. That's a 26% premium to Beacon's closing price on November 15th, the last trading day before news of the takeover emerged. And Nvidia will spend several $100 billion on chips and gears made in the USA through 2028 in an attempt to shift more manufacturing onshore in the face of tariff threats. The CEO, Jensen Huang, told the Financial Times this is part of a $500 billion Nvidia will spend on electronics over the next 4 years globally. Right now, only a fraction of the company's highly prized graphics processing units are made in America at the TSMC factory in Arizona. Sonali?
And speaking of made in America, something interesting about this Nvidia story was that Jensen Huang denied reports in this story that Nvidia was involved in discussions to be part of a consortium with the likes of TSMC, according to the Financial Times, to invest in Intel. Now, Huang did say that they evaluate their foundry technology on a regular basis and they have confidence in Intel. You do see Intel, however, down in the pre-market trading as well as Nvidia, which causes investors to really be very uncertain as to how this Intel plan is going to follow through, how these companies are going to work together in this grand American chip manufacturing story.
Well, if they're going to spend several $100 billion over the next 4 years, surely some of that could go to picking up some Intel assets if that company is indeed broken up and sold. TSMC wants to spend more. Obviously, a lot of these companies are announcing big investments in the U.S. to appease President Trump, right? He's trying to bring production onshore. The question is, how much of this spending was already in planning and has been kind of rebranded as Trump appeasement spending, and how much of it is actually new in response to the tariffs?
1,000%, and it's already priced in, and you could see that in the Nvidia reaction this morning. Where's the new money coming from? That's what investors want to know. And where is that new money coming from? Even with SoftBank and Oracle, where are they going to get those hundreds of billions?
Yeah, I mean, if I'm an investor, no matter what kind of payoff, when someone says we're going to spend $500 billion, that concerns me just a little. I want to look a little bit deeper into it. That's a lot of money to spend. And I think investors are focused on that CapEx.
Yeah, and to get more on that, we do have a special edition of Bloomberg Technology live from the NVIDIA GTC AI conference. That's going to be at 4:30 p.m. New York time. Our own Ed Ludlow will interview top executives about all things AI, and he's going to grace us with his presence.
It's Quantum Day. They call this Quantum Day.
I love quantum.
I'm sure that you do, as a Star Trek fan. All right, we'll learn more about AI from Ed Ludlow later on in the hour as well. This is Bloomberg, and this is Open Interest. All right, quick check on futures ahead of the opening bell. We see red arrows across the board, a turnaround from yesterday. We finished in the green on the S&P 500 at 5,700, and now we're looking at a drop about 0.6% on the S&P. NASDAQ futures down 0.75%. Russell 2000 futures getting hit even worse because of anybody of those three indexes, right? The last is the one that needs a rate cut the most.
Yeah, and you know, I've made a decision this morning. My decision was that there were a lot of bearish sentiments in that Fed release because you're seeing the 10-year now not only below 420, you're seeing it 417. So that tells you investors are still worried about growth. We're going to see exactly how worried. We're going to bring in Katrina.
Wait, what was your decision?
That this was kind of bad news.
Ah, okay. Got it.
Bearishness. And you're seeing that in the trade this morning. We're not wiping out everything from yesterday, but we are lower. And Katrina Dudley, senior investment strategist at Franklin Templeton Public Markets, joins us at the desk. And I know you're optimistic, which is why I started this way. If you have a market that is driving the 10-year yield lower, that has been happening because of growth concerns. And so with the 10-year 6 basis points lower this morning, it shows that growth concern still exists, doesn't it?
Yeah, but you're talking us into a recession, and that is the big danger here in the market, that we're going to talk ourselves into a recession. So let's talk about how do you manage in a situation like this. And it's so dangerous to manage by anecdote and those soft indicators and ignore a data-driven approach. And the data is coming in much more positively than you're making it out. So I am in the camp that let us not talk ourselves into a recession. Let's look at this as a correction and an opportunity.
So you're not worried then about tariffs slowing down growth and raising prices? Aren't you worried about, mass deportations thinning out the labor market? Aren't you worried that we didn't get the reduction in red tape that we were supposed to get?
So 60% of people are in the bearish category, which means of the 3 people sitting here, I've got 1 bear and I've got 2. So you're part of my data set that says this bearish sentiment is what is concerning the market. It is what is driving those soft forward indicators, the consumer lack of confidence, some of the business confidence numbers. But let's take it back to the data. Let's look at the February jobs growth number. It came in fine. If we look at some of the growth numbers, the inflation numbers have come in better than expected. So the data
This is what Powell was saying yesterday at the meeting. He's like, hey, listen, the data looks good. And the part he didn't say is, we're terrified about the future, right?
And so is the market. So when the market is terrified, what do you do? And the fact is that those opportunities where you've got so much volatility, if you look at the VIX and the highs that the VIX is hitting, if I look at that bearish sentiment indicator, it is firmly in bearish category. So the person who is going to make money in this market is the person who sits down and calmly says, yes, there's the tariff news, but am I going to be positive and look at the positive data?
Very quickly here, does this mean that you believe that the market has hit its lows?
I think we're very close to hitting its low and forming a bottom. I think trying to time the exact bottom is just too difficult a task. But you look at the market, the reaction that we're seeing going into today's open, I think we are so close to a bottom that we are in the camp that this is an opportunity. And I love the fact that both of you are bearish, because that is what consensus is. Consensus is bearish, and the people who are going to make most money are the people who are willing to be calm, confident, and step in.
All right, we're going to talk more with Katrina, get more on her investment strategy here in these choppy markets. We are less than 4 minutes away from the opening bell on Bloomberg Television. This is Open Interest. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are down and actually reaching their lows of the session. S&P 500 futures now down 0.2% NASDAQ futures down 0.8%, and Russell 2000 futures now off more than 1% on concern after Jay Powell used the word transitory, concern that the Fed won't be able to cut rates as much as the market had anticipated. There's still 2 rate cuts in the median dot plot, but maybe people don't take that as seriously. Jay Powell has often said you shouldn't. At the NASDAQ, you got Logistics Health ringing the opening bell. A new issue there. They've lost about 12% since they started trading in February. Down at the New York Stock Exchange, JP Morgan ringing the opening bell, looking at the wall there, and they have announced a new inverse VIX short-term futures ETN. In case you're wondering, an ETN is this ETN incorporated in the United States, and the fund seeks to provide exposure to the daily returns of the S&P 500 VIX short-term futures points change inverse daily index TR, which they refer to as an index. So that's not confusing at all, is it? Here's the live trade. You have the S&P 500 down 0.75%, the NASDAQ off almost 1%, and the Russell 2000 off a little bit more than that. So at the beginning of trading, at least in the first few seconds of the day, we're losing almost everything that we gained at the end of the day yesterday. We were up about 1% on the S&P yesterday, and of course, it looks like this is accelerating. And certainly futures, with futures, that was the case. In terms of the stocks that we're watching, Tesla is one. It's a big laggard in the Magnificent Seven, down almost 1%. Tesla recalled all the Cybertrucks, and that's because there were some pieces that are glued on that could vibrate and come off while you're driving. And that's concerning, but they say it should only be 1% of the 46,000 Cybertrucks they've sold since November of 2023. Sonali, what are you watching?
I am watching Darden Restaurants. We're looking at it now up 6.8% at the market open. Listen, they had reported mixed third quarter results. The owner of the Olive Garden says the consumer environment is challenging. right now. Now, remember, of course, a very significant staple here. We're looking to see if people are going out to eat still, Matt. If you remember in the most recent retail sales data, that was actually a negative read, but the companies are not showing it across the board yet.
Not only do I remember, but I'm preparing an ECAN look later on where we will focus in on that retail sales data. Right now, though, let's get back to the desk here. Katrina Dudley joins us again. She's back with us, senior investment strategist at Franklin Templeton Public Markets. And Katrina, in terms of your longer term view, we know that you're more optimistic than we are. How about tactically right now? How long until you feel comfortable going in and buying this dip?
No, I'm actually comfortable now.
Yeah.
I think you're representing a lot of short-term fears. And I think we do need to acknowledge what is being thrown at the consumer in terms of the news headlines, the tariff data, the DOGE cuts, the federal, the cuts to federal budgets, which are impacting, private institutions. There's a lot of uncertainty there, and the soft indicators are reflecting that. But there's something else in the soft indicators that we're not talking about, and I do think it's really important. And this is the extreme partisanship that is impacting this country. And I think that is actually a bigger driver of some of these more sentiment-based indicators, which is why we've got a divergence between the actual data and the sentiment.
But hang on, you don't think that's going away, right? We're not going to get any less partisan in the United States of America, are we?
I actually hope we will.
We all hope we will, but do you actually think that's going to happen?
But at the moment, do you think we can get more? That is the baseline. So the fact is that the current indicators already reflect this high degree of negative sentiment and extreme sentiment. And the fact is that it's going to get better.
This issue is something you might remember John Lewinson over at Diameter. This is what he said it was the next big risk for him, that you have investors reading partisan data and making decisions off of it. It is not the underlying fact. It is how people feel.
Right. If you look at inflation expectations, Republicans think there's no problem. We won't have inflation. Democrats think it's going to go up like a hockey stick. If you look at growth expectations, Republicans think we're off to the races in a new golden era, and Democrats think we are headed for a recession.
You couldn't have said it any better than we can, which is this idea that this partisanship is driving sentiment, which is why we need to go back to the data. So all I'm saying is that when we look at our bull-bear indicator, Wall Street's very driven by that bearish indicator, which is in extreme territory as well. So as I said, 60% of people are in that bearish camp. So we think that there's a lot of opportunity for the average investor to start buying the average stock.
What would turn that around? How do you make that 60% of bears turn into that 60%?
I think it's just some of those, it's actually just the negative news being resolved and falling away.
Tariffs.
So the tariffs get incorporated. Last time we had tariffs, actually, there wasn't such a big impact. It was more about the fear of the news and that initial fear. And then when we actually got to the eventuality of them, it wasn't so bad. So it's going to be that transition that we see. It'll be the transition once we see how private institutions accommodate some of these changes to foundations and other organizations step in. So I think we're kind of at that peak fear. And for us, that's why we think that the market's close to a bottom and we think there's an opportunity.
Depending what you want to buy, right? Because I want to buy Harley Davidson. Those prices are up like 40% since 2018. Tariffs all around. Let me ask you what you would buy in this market, Katrina. Like if I take my Doge dividend and go to you and say, please invest this for me. You just said the average stock. What do you want to buy?
So when we talk about the average stock, we're talking about the fact that if we look at earnings expectations on a 2-year forward basis, all sectors are actually doing well, and it's a much broader market. So that's why we talk about the average stock doing well. So when we think about technology stocks, you want to just go a little further down the market cap spectrum than, say, the Mag 7 stocks and look at purchasing some of those names. So that's what we're talking. We just think there's a lot more opportunity in the broader market than there is in the Magnificent 7.
Speaking of the broader market, you look at a day like today, and that bearish read is still out there, Matt. almost every sector in the S&P 500, barring utilities, is negative today. And we saw good earnings news, frankly. And so you look at the sectors that have been doing the worst this year. Consumer discretionary by far has sold off. It's down 14%. A lot of that is Tesla, fine. But even beyond that,
this is year to date, by the way.
This is year to date.
Take a look at one day, and you're going to see a sea of red there. Only utilities is gaining. Thanks, Joe.
But even on the year-to-date basis, one question I have is consumer discretionary has sold off so much that do you believe we've bottomed enough to even buy parts of the market that people are afraid of, the consumer sector?
So the consumer sector and spending there is really driven by the job outlook and people's expectations for jobs and retention. And that has been one of the changes that we've seen, that people are a little more fearful. And the cure of that is just time and employers' communication and messaging. I think at the moment, employers are a little focused on handling the tariffs, and that's generating this uncertainty, leading to concerns about the job number. Once we get through that narrative, I think people are going to be very comfortable in their jobs. We've got low unemployment, and those two things are going to start driving consumer sales.
God,
and
I hope you're
that's
right.
Well, maybe your Harley may not be cheaper.
I appreciate that. That view, right? And that's what we all want. I don't think people who are bearish want the economy to be bad and want stocks to go down. They would prefer that the tariffs work in their intended way and that the golden era drives us to growth.
Well, that is one of the benefits of tariffs, is this reshoring. And we go back to the average stock. A lot of that reshoring benefits small and mid-cap companies. And so, it is part of the narrative. It does take some time to start showing through in earnings. But as we look at that 2-year forward earnings expectation, that is part of the help, that reshoring of manufacturing.
Katrina, we thank you so much for joining us today, giving some balance to what has been a bit of a bearish market. That is Franklin Templeton's Katrina Dudley. And we're looking at some more movers on our radar this morning. Speaking of the consumer, Five Below is climbing on a strong outlook despite headwinds from tariffs. I am so interested in this because that trade down story should benefit places like Five Below, where maybe you find a charger or a kid toy there instead of maybe going to these more expensive
a kid toy
stores.
is what I'm after.
Toy for your child.
I went to buy, my daughter in the grocery store wanted a balloon. They had these fish-shaped balloons.
Did you tell her that inflation is coming back and it's not possible?
They were $13 for a balloon. I said no. FedEx reports after the bell. You saw FedEx on the board as well. Its shares are down in today's trade. Nike also reporting after the bell, and that could be, as I said earlier, it could be a tough quarter with 11% sales shrinkage there and a turnaround underway. But we will wait to watch Romaine and the close team go through those earnings for you.
Yeah, and coming up, we're going to give you another read on the consumer because Darden Restaurants had missed sales estimates, but the stock is the top gainer in the S&P 500 right now. We're going to take a closer look as to why next. This is Bloomberg Open Interest. And it's time now for our top calls. Some of the analyst action that's in focus this morning. First up, the maker of Corona and Modelo beer is no longer a buy at Citigroup. It's downgrading Constellation Brands because of Hispanic consumer weakness and tariff risks. The analyst is also upgrading the maker of Sam Adams beer on growth expectations. Constellation still up, though, 0.8%. Next up, Carvana getting upgraded to a buy at Piper Sandler as it turns bullish on vehicle technology stocks. The analyst says that the sector can grow despite higher tariffs, and the analyst also notes that automakers, except for Tesla, should be avoided. Carvana up 5%. And finally, Southwest Airlines no longer a sell at UBS after some recent strategy changes. The analyst says that the move to charge for bags shows that the company is taking a whatever it takes approach to driving financial improvement. Southwest now up 0.7%, Matt.
All right, another stock that we're watching this morning is Darden Restaurants. After that turnaround in the shares, the owner of Olive Garden says it still expects more than $12 billion in sales this year. But Darden Restaurants, which also owns the Capitol Grill down on Wall Street and the Yard House in Scarsdale, reported mixed third quarter results. If you take a look at the Bloomberg Terminal ECAN function, which we lean on a lot here, you can see retail sales figures from the BLS. This is over the past year. If you click into that yellow box, which is the food and beverage service spending figures, you can see how dire the situation is from the perspective of the U.S. consumer. Here to talk more about eating out is Michael Halen of Bloomberg Intelligence. Michael, let's focus first on Darden specifically. Why do you think the shares are doing so well after the company missed its fiscal third quarter revenue and profit estimates?
Listen, man, they missed by a teeny little bit. Give them a break, Matt. Coming into the number, restaurant stocks have been taking a beating, right, with this down move in the market. There's been a lot of consternation about the consumer sentiment numbers, right? And we take issue with some of those. But, everyone expected kind of a softer quarter. Same-store sales are up about 60 basis points. But the real news is that quarter to date, sales are up more than 3% for Darden as an enterprise. And it sounds like, the Olive Garden, Uber Eats initiatives quickly ramping for them. And it's making up about 2.5% of sales now at restaurants that have had it for some time. Longhorn continues to outperform, and fine dining did a lot better than expected. So, we're looking forward. The market's looking forward, and that's why the stock's up so much today.
What does it say, this particular company, about where the consumer is right now in terms of what they're willing to pay to eat out?
I think it's a pretty good gauge because they have a wide range of different chains, right? They range from Olive Garden and Cheddar's, which has a pretty significant number of low-income consumers, to the high-end fine dining, Ruth's Chris and Eddie V's and chains like that. So I think that for that reason, it's pretty good. But at the same time, Darden has done a good job of pricing below its competitors since the start of the pandemic by, maybe 600 basis points. And so for that reason, we came into the year expecting Darden to kind of outperform their peers, and they've done so to date.
So you say you take issue with some of the negative consumer sentiment numbers, Michael. We showed that ECAN function and food and beverage services spending seems to have gone down a lot. The consumer across the income spectrum has a lower bank balance than pre-COVID and higher debt than pre-COVID. Do you think we're being too bearish?
I do. I do. We think for a few reasons. I mean, first of all, survey data. If you read the Michigan Sentiment Survey, it's become highly politicized. And then also survey data, people all often like to say one thing and do another. Or as my friend Alan Hickok at BCG likes to say, people like to talk skinny and eat fat. So it's not, the most important thing we look at. Credit card balances are rising still, but at a much slower pace than a year ago. The delinquency data is a lot better than a year ago. I think tariff headlines have scared people. But when you really dig in, some of the CEOs that we've talked to said that the slowdown in January and February was kind of broad-based against all consumer types, right? And that, to us, that says it was more impacted by weather, which Darden credited about 100 basis points of their slowdown to weather, to a very bad flu season, right? Because we know high-income consumer balance sheets aren't worse than they were a year ago. Just a month ago, we were seeing all-time highs in crypto, home prices, and the S&P. Obviously, S&P's down, 8% or so since then, but still higher than it was a year ago. So consumer balance sheets aren't a whole lot worse. In fact, that we think most of the balance sheets are better than they were a year ago. And that's why we're part of the reason why we're more bullish on restaurant stocks. Also, we're lapping a restaurant recession. Sales were horrible last year.
Michael, I appreciate it. We appreciate you joining us here on Bloomberg Open Interest. And I love your haircut. the whole thing that you've got going on. It's fantastic. Michael Hale,
man. I save a lot of money on haircuts.
Of Bloomberg Intelligence. In the next hour, we get another read on the consumer with the CEO of Newell Brands, which owns Rubbermaid as well as Elmer's Glue. This is Bloomberg Open Interest. This is Bloomberg Open Interest. Let's get a quick check on what's going on in the stock market. We are just 22 minutes into the session right now, and the losses are not nearly as bad as they were at the open. The S&P 500 now off less than 0.25% at 56.62. The Nasdaq down even less, 19,700. The level on the Nasdaq. Small caps are still taking a beating off 0.5%, but when Katie's not here, who cares about small caps, right?
We care about small caps. We care. We just don't talk about them that much because they're indeed small. But, let's call it a little bit of a give back. It's nothing crazy today after yesterday's surge after the Fed meeting. And we're going to turn now. Speaking of giving back, we're going to talk about the strategy session because the S&P 500 will end this year in the 6,500 range, according to a new Bloomberg survey of Wall Street strategists. So that's a little optimistic there. Christina Kino works with the MLive team, joins us now. We are looking at gains for the S&P 500 by and large when you talk to the strategy community, when you talk to investors. So what's going to bring us there?
Well, Sonali, I guess it's just kind of a flushing out of this negative sentiment that we're seeing in equities right now, right? We've already seen that 10% correction and kind of a rebound from that this week. So that's helping a little bit. And, we're starting to see sentiment kind of bottoming out here a little bit. The question is kind of how investors are really going to take that Federal Reserve meeting from yesterday, because initially the message was positive for stocks, right? The fact that, they're seeing growth slowing down, but not necessarily a recession, and this whole idea of the tariffs impact being transitory, initially taken as good news. But I think what people are doing this morning is kind of taking a look at the nuances of the Fed's outlook for its rate path. It's not actually as dovish as we thought yesterday, because if you look at the distribution of the rate outlook, that's looking a little bit more hawkish and not usually good news for stocks.
I wonder how important going through the nuance of the Fed press conference is to the markets now. There are times when the Fed is everything, and there are times when I barely notice it unless I'm watching The Fed Decides with John Farrow and Tom Keene. So does it really matter that much to the market that the Fed did exactly what we expected the Fed to do yesterday?
Well, Matt, I think there are kind of signals to take from the meeting yesterday, but I think you're absolutely right. We're definitely in a world where the Fed is not the only game in town anymore for markets. That was definitely the case last year prior to Trump's second term. But of course, now we have the new administration. It's going ahead with policies that are very much game changing for the economy and therefore the stock markets. And so, yeah, I think there's a lot of kind of signals for investors to take from what's happening in policy, not just from the Fed, but also from the administration.
Christine, thank you so very much for joining us this morning. Of course, always keeping an eye on what's going on in the investor community.
Check out the MLive blog.
Check out the MLive blog.
MLIV Go on your Bloomberg terminal to watch Christine's work.
Now, I also want to talk about, Matt, with you, something else that's going on in the market. You're not seeing it on the tape yet because it's almost going to get there. It's not quite there yet. CoreWeave right now is doing a roadshow in the middle of this crazy market. I love to see it because finally you're seeing the ability for a company to maybe go public. And we have not been seeing it. You can list ETNs that nobody can pronounce, but you can't list a public company in this market. CoreWeave is backed by Nvidia. And even though they are finally doing this roadshow, it's scaled back. They're going to be probably around $26 billion at the high end of the marketed range in value. They were trying to go for $35 billion.
Yeah, exactly. Yeah, so that's scaled back quite a bit.
Right.
Interesting. Almost a third of the valuation been lopped off. And you can see why, right? Investors until now have only been putting money towards these big mega cap stocks and not so interested in the smaller ones. That's why we haven't seen a lot of them come to market. Coming up the next hour, Barry Knapp joins us from Ironsides. We also get Prince Constantijn of the Netherlands, as well as the CEO of Newell Brands. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Sonali Basak. Katie Greifeld is off today. And coming up, Powell brings back the T word. The Fed chair downplayed tariff risks, saying that the impact on consumer prices may be transitory. And speaking of the consumer, we're going to get insight from the C-suite from the CEO of Newell Brands, the company behind the likes of Rubbermaid, Yankee Candles, Sharpie pens, and more. Plus, Nvidia is betting big on American-made chips. We're live this hour at Nvidia's AI conference in San Jose, California.
All right, let's get a check on what's going on in markets. We're now looking at green arrows after a pretty negative open. We were down almost 1% on the S&P and the NASDAQ in the first few minutes of trading. And you can see that we're little changed right now on both of those indexes. The 10-year yield, to me, is really the news in markets today. I mean, we were trading at 430 for the last couple of weeks and looked like it was a new normal until the Fed came out yesterday with no moves on rates as expected, but higher interest rate a higher inflation forecast and a lower growth forecast. The question is whether you see that as hawkish or dovish. Yeah. No matter what, it chopped more than 10 basis points off the 10-year yield.
And even more movement this morning. We got as low as 417. I also want to bring you some breaking news, Matt, because on the heels of that lower 10-year relative to what we saw, of course, mortgage rates have gone down a little bit, and that has led to the data. U.S. February existing home sales rise to 4.26 million. The estimate was under 4 million, so that's good. People are buying. But the median home price had risen 3.8% to $398,400. So prices rising, which you would expect if people are buying more homes. But of course, sales are rising. That is actually very positive sentiment for the economy.
Yeah, absolutely great news for the U.S. economy. We'll continue to cover that for you. Right now, we want to talk about his interpretation of the Fed with Barry Knapp. He joins us, Ironsides Macroeconomics Director of Research and Chief Market Strategist, I'm guessing out of Vail, just looking at the slopes behind him. Barry, what did you take from yesterday's Fed meeting? I mean, there was no move with the exception of the SEP, but it seemed that Jay Powell was kind of walking on eggshells when talking about inflation and actually used the word transitory again.
My main takeaways, the first issue and the real shocker yesterday was the decision to reduce QT from, at least in treasuries, from $25 billion a month to $20 billion a month, or to $5 billion a month, excuse me. Their framework that they'd previously delineated from people like Roberto Perli down at the New York Fed provided no justification for this cut. There'd been some discussion that when the Treasury, the debt ceiling issue's resolved, Treasury needs to issue more bills to build back up their checking account at the Fed, the TJA Powell kept referring to. But none of that really justified a reduction of that much in the way of their monthly runoff of their balance sheet. So, my first reaction to that was, what the heck are you doing? But then as I started to think about it, and they'll never admit to this, and the motivation isn't nearly as important as the implications, but I think that Bessent and Powell may have had a meeting of minds about keeping the most important price in the global capital system, the 10-year Treasury yield, stable while they go through this big, what Bessent described as detox process from the addiction to government spending. I called it cleaning up the industrial policy mess when I wrote about this 4 weeks ago and called for a correction in equities and a rally in treasuries. But that is a very significant technical decision, and it is an easing of policy.
Barry,
there's just no two ways about it.
I'm so glad you brought this up. And I also want to point out, as we've been speaking, the bulls are back, I guess. I mean, to some degree. You have the S&P 500 now up. It was down on the morning. And you saw that bid into the 10-year come at a significant pace this morning. Is a lot of this technicals? I think one fascinating thing that you're talking about is that the Treasury Department and the Fed seem to be on the same page. How bullish is that?
Well, it's bullish for the back end. There is still this ongoing long-term issue. I've been wildly critical of the Fed through the entire tightening process. They eased mostly through their balance sheet, and they tightened mostly using the policy rate. that caused return on equity in the small banks, the regional banks, Sonali, right up your alley, to collapse all the way down to 5%. Now, when the curve disinverted in the fall, that jumped back up to about 7 3/4, but this is still too low. There's a lot of pressure on small banks, small businesses, floating rate borrowers versus fixed rate borrowers. This doesn't really resolve it, but it does allow for a smoother process as we go through this, this detox process. There's a couple other things I would mention about all this too. One is the way Powell characterized the primary objectives or issues around the changes that the administration is trying to make is he listed it as trade, immigration, fiscal, and regulation. I would have not put it in that order at all. Maybe he didn't mean it to be in order of importance, but I would describe spending as the most important issue to stabilize the Treasury market over time, taxes as the most important issue to try and rebuild capital spending, which has been falling for 2 years. Then it's regulatory policy, then it's immigration. The least important is trade. That's the one we're all focused on, but the Fed shouldn't be focused on that. They should be focused on smoothing the cuts in government spending, the potential fallout in the labor market. And, a man I know reasonably well, and you guys had on right after the meeting yesterday, former New York Fed President Dudley said the thing to watch is the unemployment rate. I absolutely think the labor market is very unstable here. Churn has collapsed. Hiring rates have collapsed. The U6 underemployment rate jumped from 7.5 to 8 last month. It's likely we're going to get a very weak report. And I think the Fed could be pivoting to rate cuts as soon as intra-meeting and potentially cutting in May. So big change in Fed policy here on that.
Potentially cutting in May. I can't remember if it was Bob Michael yesterday who said that he expects, if there's not a cut in May, there are not going to be any cuts this year. Is that, you think, the case? And how many cuts do you expect? Because the dot plot showed that at least the median estimate or forecast or whatever you want to call it here is for 2 cuts this year.
I think Bob makes a decent point. I'm not sure I would have gone quite as far as him. As I've been saying, the labor market foundation is really unstable. I reject the idea that last month's report was strong. The work week is at lows. The job finding rates collapsed. It's in a very precarious position. We've received a pretty serious business confidence shock right now. And so whether that translates, and we're going to reduce government employment and contractors related to government. So the risks are in the near term. But I think saying if it doesn't happen in May, it won't happen all year, I think is a little extreme. It could be June, but I think they will very likely restart the cutting process. And I expect them to cut a fair bit this year. So,
a little earlier you said that you had been eyeing a correction. You'd been calling for it. Barry, do you think it's over?
Well, I expected 10 to 12%, which is typically what you get related to a real deceleration in growth, soft patch growth scare. I don't think we're going into a recession, but we could get close over the next 2 quarters as we cut government spending before capital investment recovers, hopefully in the second half of the year, if we can stabilize business confidence. So we've gone down about as much as I thought. I think 10s will probably go to 4% here. But the time frame is a little bit early for us to bottom. So I disagree with those talking about survey measures like, the AAII measure showing extreme bearishness. The volatility markets haven't really shown that. Yeah, we got some disinversion of the VIX curve and the VIX is up, but none of these things really point to an extreme move in positioning that would sustain a rally from this point. So I think it's too early for a sustainable bottom to be in or some sort of V bottom to form. Those are rare anyway. I think it's probably, but when the Fed starts to make the pivot, the market will initially react favorably, but then you're going to get the oh no moment. Maybe the Fed knows something we don't know, and maybe the economy really is headed for a recession. So, I think we're going to flounder for the next couple of months. And then if we can restabilize business confidence and show some evidence, green shoots that capital investment really is going to improve. And my framework for this is In the fourth quarter, we had a positive 50 basis point contribution from government spending and a negative 50 basis point contribution from capital spending. Software investment, intellectual properties investment had slowed to zero. That is not the long-term trend. So we really had a negative environment, and we really have to improve private sector investment to get the economy on track and get to the other side of the, I keep using the expression because I liked it so much, the detox process.
Barry, we thank you so very much for your time this morning. That is Barry Knapp of Ironsides Macroeconomics. We all are going through a detox, although what did Michael Halen call it? Say you're being healthy,
he
but
says,
eat fat.
Talk thin, eat fat.
Talk thin, eat fat. It's what the market's doing. That's what we're doing.
Yeah, I'm not planning on detoxing at all.
No
actually.
way.
Speak for yourself.
But speaking of privately held companies, we're going to break into the U.S. market. We're going to talk to Prince Constantijn of the Netherlands and Marjella Lecourt-Alma of Datamaran, joining us to discuss their efforts to help startups from the Netherlands break into U.S. venture capital. We're going to talk about what it's like to stay private, go public, all of the above. This is Bloomberg Open Interest. Now, TechLeap is a startup out of the Netherlands that is helping support Dutch technology entrepreneurship here in the United States. And they are in New York this week with a number of Dutch startups to host meetings with top venture capital investors and U.S. unicorns. Joining us now are TechLeap special envoy, who is Prince Constantijn van Oranje, and Datamaran CEO, co-founder Marjella Lecourt-Alma. And Datamaran is a company deeply integrated into the Dutch tech ecosystem and is hosting meetings, of course, is here in New York and in London and in various locations around the world. Now, let's talk about the vibe you're getting here in New York. It's an interesting time because people are interested in technology. The markets, though, have been shaky. The IPO window is something people have been waiting to see open up again. What are you seeing in your conversations?
Well, exactly that. I think there's a lot of perspective on IPOs, and I think the same in Europe. We're really hoping that this market starts to flow again. There's also some insecurity about where things are going with the tariffs, but I think there's a lot of enthusiasm to still, invest in the U.S., to come to the U.S. to find investors and to build here. It's still, for many of the companies, it's probably their fastest growing market and an important market to be in.
Now, interestingly enough, you have raised money recently, Marjella, for your company, Datamaran. What was that like? Do you think the environment today is like it was just last year, or do you think it has changed meaningfully for other companies that are looking to tap the market?
Yeah, so obviously there's a lot of uncertainty in the market today. And I think what we experienced during the Series C round is that we were dealing with a party that was looking at the market already in a bit more of a selective way. So looking for companies that were prepared to create long-term value, very much looking at our business fundamentals, at the founder composition. And I think that's probably one of the opportunities that we see today, is that there's not a lot of money perhaps flying around to invest in what I would call bets, right? Placing bets on a lot of companies. But I think the opportunity is for investors to be more selective. And I think also when you look at the Dutch ecosystems, these are typically companies that fly a little bit more under the radar. That might not seek the spotlight immediately, but for that reason might, have very strong business fundamentals because they've been bootstrapping and really making sure they got their value proposition right.
Now, what's interesting also is your company deals with artificial intelligence. The other advantage is it deals with companies that are business-to-business seeking here in the market. What about the companies that you're working with, Prince Constantijn? Do you see the need for artificial intelligence to be part of the story? If it's not part of the story, are companies going to have a harder time?
Oh, yeah. No, I think we can see a number of different companies. You've got the AI native companies that are building parts of the AI stack. Those are, of course, in very high demand, and we've seen them all across the world, across Europe as well, I think. But those are the companies we would like to see more of. Then we have a lot of companies that are applying AI, even new companies. And then we have a whole bucket of companies also in our community that are all SaaS companies. And those are all refiguring out their business models and their go-to-market, and I think there's the biggest challenge, because a lot of money has gone into these companies in the past. They were the darlings of VC, And they now have to really adjust really rapidly to become AI native, and there we see the biggest challenge.
It's interesting also, to what extent is a path to IPOing important?
It's critically important, though many companies in Europe and Netherlands would also look at M&A exits. But the IPO, of course, that's the North Star. Yes, the holy grail, and that market has been largely inactive, and we hope that this year to see some of them. Of course, the Klarna IPO is one of the bright spots, and we hope that that's going to ignite many more IPOs this year.
How do you feel about this, Marjella? If you think about it, it's interesting. At the very moment, we're watching one company out there look at a roadshow, start a roadshow, but CoreWeave, as it goes public, it looked to be a $35 billion company. It's looking like it might be less than $26 billion in public markets. Are you watching these instances to determine how you might look to IPO one day?
I think at the moment, we're very much looking at how can we best serve our customers in a time that there's a lot of volatility, there's a lot of uncertainty, both when you think about our business, we're dealing with the omnibus in the European Union, so the Simplification Act on the Corporate Sustainability Reporting Directive, pushing companies to rethink their strategies as to long-term value creation and sustainability. And at the same time, there's developments here in the US as well. So we are very much at a time where we're closely looking at the customer. What does the customer really want, and how do we best reposition and respond to those changing market needs? So we're not as much thinking ahead in terms of like IPO and what's ahead in 3 to 5 years. It's just very difficult to do that right now. We are doubling down on making sure that we are providing the right set of tools, platforms to the customer.
It's a great point. You look here in the United States, and a lot of those efforts surrounding energy sustainability governance have been unwound. They have been taken back in many regards. How do you think about the energy transition, green technology, as you talk to startups in the Netherlands? Is it something where some of those priorities for international companies have changed meaningfully, or do you see there are places where this is still a huge priority?
No, it's definitely a huge priority. The underlying logic is still the same. We need to be less dependent on fuels, and we're seeing this. I think there's more inconsistencies in the support policies. So many of our solar companies having big troubles at the moment. Then there is some of our circular plastics companies are having problems because the price of plastic from China is just so low. And if policymakers then don't step in and create a market, then for those companies it's going to be very difficult. So we do see in very specific niches we see issues, but on the whole the fundamentals around energy transition, less dependency, bigger diversity, diversifying the energy mix, I think that's still the same, and we've seen a lot of companies entering in this space.
We thank you both for joining us here on set in your visit to New York City. Of course, a very important time to be talking to the venture capital community. That is Constantijn van Oranje of TechLeap and Marjella Lecourt-Alma of Datamaran. Now let's get a check on markets here, because of course it's been a choppy trade this morning, and we had seen the S&P 500 flip into the green. Looks like it's staying there. It's up about 0.3%. The Nasdaq 100 up 0.4%. This of course comes off the back of a rally we saw on the heels of the Fed decision yesterday. Looks like investors still have confidence here. That 10-year yield now back up to 4.2%. We saw it jump a little bit below just really about a half an hour ago, but now has flipped higher on yields, which is actually not so bad if you're not too worried about growth, even though the Fed says it will be impacted. We'll bring you more markets ahead. Stick with us. This is Bloomberg Open Interest.
Let's get a look now at high interest, what's making headlines around the world. Nike has lost 44% of its value over the past 3 years, and we may get another reminder of why this afternoon. The Beaverton, Oregon-based shoemaker will post fiscal third quarter earnings after the bell, and analysts project quarterly sales sank 11%, which would be the biggest drop since the depths of COVID. The CEO, Elliott Hill, who took over in October, has been clearing out the ranks. The departures of the Chief Strategy and Transformation Officer, as well as the Chief Communications Officer, were announced yesterday in an internal memo. FedEx is expected to cut its annual outlook or guide to the lower end of the current range when the company reports third quarter earnings after the bell today. Some of those challenges the company faces include tariff uncertainty, weak consumer demand, and lower manufacturing activity. The company lowered its adjusted earnings per share outlook last quarter. And U.S. listed shares of PDD are down in the early trade this morning. The parent company of Temu missed sales estimates last quarter, notching a third miss in a row. The Chinese budget shopping site's results indicate heightened financial risk posed by U.S. tariffs on China to Temu's growing global business. Let's get a quick check on what's going on in the markets. About an hour into the trade now, we do see green arrows across the board here, and we're climbing to session highs. The S&P 500 up 0.5%, the NASDAQ 100 up more than that, and the U.S. 10-year yield holding now right at 4.20, down about 10 basis points from where we saw it at this time yesterday, and below the close of trading. So it does look like the Fed pause is being read now as dovish. Of course, the Fed also raised its inflation outlook for the year and lowered its growth forecast, but the dot plot still has, at least at the median, 2 cuts factored in for 2025. Coming up, Newell Brands joins us. They say they're in a better position than others when it comes to tariffs. Christopher Peterson, the CEO and president, explains next. This is Bloomberg. This is Open Interest. Newell Brands says it is preparing for tariffs, and it has been for some time. The company behind brands like Rubbermaid, Yankee Candle, and Elmer's Glue has been shifting production out of China for the last few years. Chris Peterson, the president and CEO of Newell Brands, says this leaves his company better positioned to navigate upcoming tariff headwinds. And Chris joins us on Open Interest now. Chris, thanks so much for your time. Let me first ask about your supply chain. You know, how much of it was in China, and outside the U.S. previously, and how much are you producing here in America now?
Yeah, great to be with you. So about 60% of our business is sold in the U.S., 40% is sold outside the U.S. The majority of our U.S. business is manufactured in the U.S. We have 15 manufacturing plants in the U.S. That are Newell manufacturing plants producing products here. Outside the U.S., the biggest country that we were sourcing from previously was China. It represented at its peak several years ago about 30% of our global cost of goods sold. Today, that number is down close to 15%, and by the end of this year, it should be down to about 10%. So we are exposed in some of our product categories to China imports, but the majority of our U.S. business is made in the USA, and we believe that's a big advantage for us.
You know, in addition to the questions around China, more importantly, perhaps because of the uncertainty and the near-term uncertainty, is also Mexico. You recently told investors that roughly 5% of your cost of goods sold were from Mexico. And so what kind of uncertainty do you see among the North American agreements that are in place, and how investors should be thinking about how you move forward in the middle of that uncertainty, or how you navigate it?
Yeah, it's a very dynamic environment. We obviously are paying very close attention to the trade and tariff policy coming out of the administration. We have 2 manufacturing plants in Mexico. One is a blender plant that largely supplies Latin America, that would not be subject to U.S. tariffs, but they have a small amount of business that comes from that blender plant into the U.S. that would be subject to tariffs. We also have a small volume writing plant in Mexicali. Our biggest writing plant with the high velocity items is in Maryville, Tennessee. And so we have flexibility to move manufacturing a little bit over time. And we are evaluating the situation, and I think we are well positioned to respond dynamically.
Chris, as somebody who's made the changes earlier on to bring more manufacturing onshore, to make sure that reliance is not entirely on China, what can you tell other CEOs? What do you tell investors about that process? Has it been enormously expensive? Does it mean that you've had to stomach higher cost of production? What should people know?
Yeah, I think a couple of things. So first of all, since the 2017 Tax Cut and Jobs Act, we've invested close to $2 billion in U.S. manufacturing as a company. So we have invested in our U.S. manufacturing plants. And importantly, we've invested in automating our manufacturing plants so that today, our 15 manufacturing plants are highly automated, and we believe they are cost competitive on a fair trade basis with any plants that are producing these products anywhere in the world. So we think the U.S. can be a great place to build manufacturing plants, to be cost competitive, and to supply the U.S. market.
I'm looking at your stock, Chris, and I always take a look at a company's stock over 5 years. It's just a sort of default setting with the comp function on the Bloomberg, and I think it's a pretty fair representation of what's going on. It's down 42%. What are investors not understanding about this story, or why have they sold off this stock?
Yeah, so I became the CEO in May of 2023. And when I became the CEO, I looked at that same chart and I declared the company a turnaround. And we went through a very diligent process to look at the capabilities that were required to win in this industry. That led us to coming out with a new strategy, which we publicly announced in June of 2023. We've been implementing and operating against that new strategy now for close to 2 years, and the strategy is working. So if you look at our results in 2024, for example, we improved our rate of core sales growth on every single business. We grew our gross margin in 2024 by 460 basis points. We significantly generated cash flow and delevered the balance sheet, but there's still more work to do. I think more recently, the stock has taken a little bit of a downturn because people are worried about our ability to navigate the trade and tariff dynamic. I believe there's going to be opportunities for us to be beneficiaries in our U.S. manufactured goods. And and of course, we're going to respond appropriately to the goods that we are sourcing from outside the U.S.
Chris,
so
there's one of your products actually that has been playing a very key role. The president has been using a Sharpie to sign those executive orders. It has really taken on a personality of its own, this black Sharpie. So have people been buying more Sharpies? I'm wondering if that's had any impact on the notice of the brand.
Yes, Sharpie is one of our largest brands. It's a great brand. We returned the brand to growth, and so Sharpie has been growing the last couple of years. It, of course, is known for being a permanent marker, and it has a dominant market share. It's all made in Tennessee, and we've extended the brand into gel pens and most recently into creative markers. And so we think Sharpie is a beloved brand that has significant growth opportunity as we better understand consumer needs and innovate with new products that delight consumers.
All right. Very cool.
Very interesting. Chris, we thank you so very much. We'll be keeping an eye out on Newell Brands. That is Chris Peterson, the CEO of Newell. Now, we got breaking news about 30 minutes ago. It really caught my eye. I think it caught Matt's too. A group led by William Chisolm and backed by private equity fund Sixth Street has reached an agreement to buy the Boston Celtics for $6.1 billion. It is the most expensive sale of any North American sports team. We're going to bring in our own Bloomberg's Randall Williams to talk more about what's going on. That is quite the price tag.
Yeah.
And, you know, one thing that struck me about this was Sixth Street's involvement, too. You finally have much more private equity interest in these teams. You have to wonder how much it's driving up the prices because there's more money to back these deals.
For sure. And we reported earlier this week that Sixth Street was already an investor in the San Francisco Giants. Now they doubled down with the Celtics. They're very, very active in sports. They also have NFL approval, and they've put up north of $1 billion to help buy the Celtics.
So Sonali is like watching sports all the time because she bets money on these events.
She's a FanDuel girl?
I can't argue.
I haven't really watched basketball since Larry Bird was wearing the uniform.
Long time.
How are they doing?
The Celtics?
Yeah.
They're one of the leading teams in the NBA's Eastern Conference. They won the title last year. They could be competing for another title this year, and I think people expect them to go far in the playoffs.
Well, what about this deal itself? Why William Chisolm? Who is he?
He is the CEO or founder of Symphony Tech, and he has a group that's backed by Rob Hale and other investors. The exact details of his consortium outside of 6th Street, Rob Hale, and there's another person who I'm forgetting the name of, we don't know just yet.
In terms of, deals, we've seen, obviously, private equity start to come in and buy NFL teams they're allowed to have stakes in now, right? There's been a lot of movement. Is that going to continue? I mean, we watch M&A on the street, right? But what about in sports?
I think so. You're going to continue to see private equity get into sports franchises, but it's really going to depend on what they'd like to invest in. Now, the Celtics are an iconic franchise that we see succeed all the time. I mean, we're talking about a championship last season. When you're thinking about the NFL, for example, when Aries bought into the Dolphins, that deal included the Hard Rock Stadium. It included the Formula One Miami Grand Prix. It also included the Miami Open. So it really depends on what an institutional investor is looking for, and 6th Street has found what they're looking for twice in 1 week.
Yeah, it's interesting because, twice in 1 week, it's striking me. To your point on private equity here, you can't see that many deals in normal course of business, but club deals, barbarians at the gate style club deals are coming back in sports. You know, the Dolphins deal was just a couple months ago. What do you think is next in terms of the next big prize asset in sports that you're keeping an eye on?
Well, I think it's to be determined. There are some NFL teams that have clauses where, when an owner passes away or dies, that, they'll go up for sale. But that could be 10 years, it could be 5 years. We just don't know. As far as the Celtics, they have to go to the Board of Governors and get approval. That's a pretty standard process. But, the NBA governors will meet sometime soon and they'll look at this. And I think that a lot of NBA investors and people who are interested in NBA expansion will be like, okay, this sets the mark for what we do and don't want to pay. Do we want to pay $6 billion for a potential 31st and 32nd team in the NBA, or do we want to pay less?
After this, I'm going to go watch March Madness. And,
Have you filled out your bracket?
No,
it starts in like 30 minutes.
I know. I didn't fill out a bracket.
I think you're not allowed to fill it out anymore.
No, you're not. It's done.
No. You can now. You have like 30 more minutes to fill out your bracket. BRKT go.
Bracket.
Randall, awesome reporting. We have to have you back on. Randall Williams there talking to us about a $6.1 billion sale of the Boston Celtics. Coming up, we're going to head to San Jose and the Nvidia GTC AI conference, where it is apparently Quantum Day. I guess that means something. This is Bloomberg Open Interest. It is Quantum Day at the Nvidia GTC AI conference. It's already been an eventful week for one of the most important stocks in the world. We head to San Jose now, where we are joined by one of the greatest reporters in the world, Bloomberg Technology's Ed Ludlow. Ed, it's fantastic to see you, and I'm sure you're having a great time at this massive conference. First off, I have to ask you about the $500 billion FT story. That seems like a lot of money, and I didn't know Nvidia would be spending that amount over the next 4 years globally. How much of that is going to be here in the U.S.?
Yeah, I mean, it's a significant headline, but it's important to clarify that it's not CapEx. The way to think about it is that Nvidia's data center business, in other words, the business of putting infrastructure in place for AI, is already well beyond $100 billion annually, the bulk of which is in the United States. It's a segment that's estimated to grow 20% annually from here on in, give or take. And so what Jensen Huang's talked about a number of times, actually, in the last 2 days, is the idea that they've increasingly shifted their supply chain onshore in the United States. TSMC in Arizona, as it ramps up, they will commit more of the manufacturing of the key GPUs or AI accelerators to what's available. But by virtue, it's the cost of doing business, essentially. If you have 70% market share of what is 100 billion alone for that company, inevitably over the next 4 to 5 years, they'll be spending similar to get those data center either refreshed with latest generation hardware or put new hardware in from the start.
Ed, as much as I want to ask you about quantum computing, I am very interested in it. I actually want to know first what you feel about the denial that Jensen Huang had in that story about any consortium around Intel.
Right, we are having Quantum Day today because of what happened at CES in January. During an analyst Q&A, Jensen Huang was asked, what do you think about quantum? He said, with his genuine belief, that quantum computers were more than a decade away from doing anything useful. Nvidia already supplies the quantum industry. It does not make quantum computers itself. But what they do is provide their own AI supercomputers. Those AI supercomputers are simply used to calibrate and reduce error count on quantum computing. They are two completely distinct fields. But of course, at the time, you saw those quantum stocks go into free fall. That is the weight that Jensen Huang carries. Today, there will be several thousand people in a room where Jensen Huang will speak to the CEOs of those quantum companies and try and find some middle ground. But let's be absolutely clear. Nvidia does not make quantum computers. It sells its existing technology, the GPUs that it manufactures for training and inference on AI models, to help those quantum computers make their own technology better. It's as simple as that, though I'm really curious if the reaction today to what Jensen says is as severe in either direction to what happened in January. That's the simple fact of it.
Ed, I'm sure you've been watching, as we all have, this drawdown in the Magnificent Seven stocks, which, you know, the majority of them you cover very closely. I guess all of them you cover very closely on Bloomberg Technology, which you co-anchor with Carolyn Hyde. What's your thought on the broader market going away from these mega cap stocks that supplied the bulk of the gains we've seen on the index level over the past couple of years?
There's the macro level effect, of which I'm no expert, right? But all of those stocks have had that decline since President Trump's inauguration. And that's the sort of post in time that we're marking it by. There is an element, particularly as it relates to Nvidia, about how much you believe the sustainability of all of the hyperscalers, the cloud computing companies investing in new data centers. It touches all of those companies in some way, including Tesla to a certain extent, because they also rely on Nvidia hardware as well as others. And this was what's so interesting about Jensen Huang yesterday. He was super frustrated because he basically said, I've done something that no company's ever done before, particularly a technology company. I've told you what I'm going to do for the next 4 years. So why is it that you don't believe me? He gave the analogy of a Louis Vuitton handbag. When does Louis Vuitton ever release its 2025 handbag and say, by the way, here's my handbags for 26, 27, and 28? That doesn't happen. And Jensen's argument is, why is the market not seeing, I've told you what happens in the next 4 years, and we're a foundational company in this space, all of the other technology companies will follow suit. That's the argument he made. The stock's up 1.7% today, but I mean, it is a point in time. It's been choppy all week, and I think there's still a lot of disbelief of the staying power, particularly in a recessionary environment. And again, when it comes to economics and macro, I'm no expert. I just like boxes, gadgets, and electronics.
And handbags. Ed Ludlow, we thank you so very much for your time. We can't wait to hear from you, because this afternoon at 4:30 p.m., there's going to be a special edition of Bloomberg Technology live from the NVIDIA GTC AI conference in San Jose. And coming up, we're going to have an inside look. We're going to switch gears, talk about banking, because Citigroup's private equity club has flopped, and it's left a lot of billionaires disappointed in its wake. That's next in the Wall Street Beat. This is Bloomberg.
This is Bloomberg Open Interest, looking at gains right now in terms of the major indexes. You can see the S&P 500 currently up 0.5, about 0.5%. The NASDAQ 100 up 0.6%, and the 10-year yield still down 3 basis points, but at 4.21. It's not as weak as it was when we first started this show about 2 hours ago. We were looking at 4.17. So
yeah, it's interesting.
A little ground back.
Fascinating to see yields higher, but it's less bearish because you're not as worried about growth. funny market, a little upside down. And, we woke up on the wrong side of the bed, but we are back in the green. So we are going to turn now for a minute. Well, things are calm. We're going to turn to the Wall Street beat. Today, we're going to look at Citi's private equity club that was launched in 2012 with Silverfern. And it was designed to offer exclusive investment opportunities to wealthy clients. But instead, it created unhappy billionaires, legal battles, and a hard lesson on the pitfalls of marketing private assets. Bloomberg's Todd Gillespie has the story. Pretty fascinating. I mean, the wealth business, of course, is very near and dear to Citigroup. Private equity is a huge part, private credit, huge part of that story for wealthy clients. What went wrong with this initiative?
Totally. Well, you go back in time, Sonali, it all looked rosy at the time. Big banks were looking to offer these new types of alternative investments to their clients. They didn't have access to these kinds of markets themselves. We're talking 2012 when this initiative started. And it looked like they could partner with this intermediary, Silverfern. These people came along with a great idea. Looked like great. Citi and Silverfern can cut the fees. Everybody wins. But what happens when deals don't turn out? What happens when the products that you're actually marketing your clients aren't very good?
Yeah, people get angry, obviously. And as we point out, I guess, in the headline, that these are billionaire members who were angry. When me and Sonali get mad at you, it's no big deal. If a billionaire gets mad at you, it becomes a problem, right? And they bring
depends on how loud you scream, I guess.
and they bring lawsuits, right?
No, I have nightmares about you getting mad at me, guys, on TV. Yeah, exactly. Right. I mean, what happened really? Silverfern were quite frustrated that they weren't getting the traction with Citi's clients, right? They thought in some way Citi had some kind of responsibility. They claimed that Citi had some kind of responsibility to market, to make sure that their clients were actually putting in the money to these deals. There's one quite amusing correspondence in the story where Clive Holmes, one of the founders of Silverfern, along with his wife Rita, complains that a billionaire client of Citi's, who is worth 4 times George Soros, invests only $500,000 into one investment. And Clive says, "Oh, this is, my car costs more than that." So, I don't know how much your car costs, Matt, but more than $500,000 is,
That's a very expensive car. I don't have, to be clear, any cars that come near to that mark.
Well, just to be clear, right, I mean, this litigation finally ended in February, more than a decade after this program started, years still after things started to sour. But it really is an interesting step-by-step showcase of what can go wrong.
Real quickly here, Todd, is there reputational damage that Citi had suffered because of this initiative? That's, I think, what people were really watching. Can they keep these billionaire clients happy as they go through this transformation?
Yeah, I mean, it's a good question. And I mean, you see in the story that one of their Latin America, the person who now runs most of their Latin America investment counseling services, she says, take a look at the clients who were part of this club at the time. None of them are doing private equity with Citi anymore. But that's also, just to bear in mind, not necessarily Citi's fault, partly Silverfern's fault, maybe for putting these clients off as well. But it's also a responsibility of the fact that private equity companies are building out their own wealth divisions, going straight to the source, going straight to these big clients with their own wealth teams, their own relationship managers, and don't need these banks anymore.
Super interesting dynamic. Todd, we thank you so much for your time. That is Bloomberg's Todd Gillespie. Of course, one of the most read stories on the terminal this morning. Yeah, and by the way, we are going to talk about cars that cost more than $500,000. Next week, at this time, we're going to have Singer on. Very excited. Rob Dickinson from Singer, the company that makes backdated Porsche 964s. Coming up tomorrow, though, on Open Interest, we have a fantastic lineup of guests as well, including Electro-Harmonix founder Mike Matthews. You may know his Big Muffs guitar pedal used by the likes of Jimi Hendrix and Nirvana. Vijay Rakesh joins us from Mizuho, and Ann Barry of Threadneedle. This is Bloomberg.